So how do you know how much you qualify for? Well, we have to figure out your debt to income ratio. So in this video, I want to explain how we calculate debt to income. So it's all of your debts calculated and added together, divided by your income. And what debts do we actually count? Do we count your cell phone, your insurance, or things like that? No. So the ones that we put into your debt to income ratio is the new housing payment, and that's the principal and interest, the property taxes, the homeowner's insurance, the mortgage insurance if there is any, and the HOA if there is one. And then we add that to all of the rest of your debts. So if you have a car payment, if you have student loan payments, the minimum monthly payments on your credit cards, or any other installment loans, lines of credit, anything that you have that's going to show up on your credit report. So we add up all of those monthly debts, and then we divide it by your monthly qualifying income. And I'm going to do a different video on qualifying income, so look for that one, because income is very complicated to calculate sometimes, especially if it's variable income or self-employed income. And it's pre-tax income, before you have any Social Security taken out or any insurance or any of those pre-tax deductions. We're using the number before that, so the biggest number that you get paid. So all of your monthly debts divided by your monthly income gives us a ratio. And depending on the loan program that we're going with, there's a maximum amount that's allowed for that ratio. Some loans, like portfolio loans, jumbo loans, that's 43%. Some loans will go up to 50%. And even some government loans may go a little bit above 50%. But 50% is usually the maximum, so that's a good way to think about it. It's also really easy math in that your income has to double your debts. So that's an easy way to think about it, and that's how much you qualify for. But you do have to count in everything. So it gets a little tricky sometimes when we're trying to calculate your principal and interest, taxes, and insurance payment for the new house, because we don't always know exactly what your tax rate is going to be for that property, or what the taxes are. And depending on who you choose for homeowner's insurance and what coverages you have can depend on how much your homeowner's insurance is. So you want to make sure that you're calculating that accurately and giving good estimates for your homeowner's insurance and a good estimate for the property taxes in the area that you're looking to purchase in. So if you have all those numbers, then we can kind of work backwards to figure out exactly how much you qualify for and how much home you can afford.
This has been Trisha Ghosh of Trisha Talks Mortgage.